This is Chad Aiken coming to you from the Aiken Research Group. It is Monday, December 14th, 2015. Well, today we're not in the studio or in the kitchen, but I thought it was important enough with the developments that are going on today to be able to have this podcast. And today we're going to talk about the high yield market and the problems that we're having in the high yield bond market, as well as an article that appeared in the On Investing magazine. Should be able to see it here. Page 6 and 7 of the On Investing magazine from Charles Schwab. On here we've got what rising interest rates mean for you. And we've got all of these boxes down here with different types of investments. And they have them color-coded so that the investments that are positive are being green. The ones that are going, the investments that have a negative impact of the rising rates are in red, and then the ones in yellow are uncertain. Now, let me just say that, I used to work at Charles Schwab for 10 years. So it's my former employer, and most of the time, the majority of the time, I think that Charles Schwab does a fantastic job with trying to help the average investor out there. Now, unfortunately, we're going to be a little more critical today of this specific article in the magazine produced by the Charles Schwab Investment Research Department. That's what I want to cover today. So let's get started. So the article title again is What Rising Interest Rates Mean for You. Now, they have color-coded in green boxes, meaning a positive environment for rising rates. And those green boxes include cash, CDs, savings, the stock market, and financial stocks. Now, when we're talking about cash, CDs, and savings, while it is true that if Janet Yellen, which I kiddingly call her Lucy, because she always pulls the football away from Charlie every time that she keeps talking about raising rates, but she never actually does it. Now, this Wednesday, we'll see if she actually keeps the football there to raise interest rates by a quarter point. Now, obviously, if the federal funds rate rises by a quarter point, that then the cash, the CDs, and the savings accounts will offer a little more to you than what they're currently offering. Let's just assume it's zero, right? But the difference between offering savers zero versus offering savers somewhere between 0.25% or so is really meaningless in the real rates of return, which we should be looking at, because you can only spend money. You can only buy something with money. Well, let's just assume the inflation rate right now is 1.5% to 2%. Well, if you put money into these green savings CDs before, you basically got zero. Well, you were actually losing 1.5% to 2% a year. You were behind. Not such a good thing, right? You want to get ahead of inflation. Now what they're saying is, well, just because, basically Schwab is saying that just because now they're raising a quarter point, the real returns are still negative. So instead of, let's just assume interest rates are 2%. So before this, you were losing approximately 2% in your savings. Now you're only losing 1.75. Is that enough to make it green, to put your money into? I would say it's not. You don't want to lose 1.75%. You want to gain more than the 2% inflation. Now, there's a great analogy for inflation and rates of return in these green boxes. For those of you that have ever went down to Florida primarily, I don't know if they even still have them. They used to have the dog races. And the dog races were pretty interesting because you're used to seeing horse races, and seeing dogs circle a track is a little bit different, especially even with people betting on which dog's going to win. That's sort of crazy in itself. But what happens is, for those of you that have been to a dog race, there is a mechanical pole with a rabbit on it. And that rabbit is always ahead. So when the dogs come out of the boxes, this mechanical machine has the rabbit on it, and it moves the rabbit around the track. The dogs are chasing the rabbit to the finish line. Unfortunately, they never get the rabbit unless the machine breaks down. Well, when you're investing, you want to think of your investments in sort of in relation to that rabbit. That's the inflation rabbit. You see, the dogs behind the inflation rabbit are behind it. They're behind by 2%, right? They never get ahead of the rabbit. See, investing in these green squares at Charles Schwab, your investments are never going to get ahead of the inflation rabbit. You see, you want investments that are going to get you, if inflation is 2%, more than 2%. If you can get more than 2% in your investments, then the dog, let's say the savings was at 3%. Well, now that savings dog would be being able to get ahead of the inflation rabbit and be ahead of the rabbit, leading the pack by 1%. See what I'm saying? You don't want these dogs. You don't want the dog of savings behind the inflation rabbit of 1.75%. You don't want cash behind the inflation rabbit of whatever that is. You don't want the certificates of deposit behind that inflation rabbit. I mean, we're just including the inflation rabbit at 2%. That's what the federal government tells us inflation is. But really, I've stated before on other podcasts, why do you care what the national inflation rate is? You really care about what your personal inflation rate is or what your household inflation rate is. Really, if you believe your household inflation rate is larger than 2%, you need to put your investments in something that's going to get more than 2%. If you have kids' activities, those are going through the roof. If you have to pay for college education, that's going through the roof. Your personal inflation rate, if you have kids and they're going to college, we can assume that the inflation rabbit that's ahead of these dogs is even larger, is even more than 2%, right? The distance is even further. But again, Charles Schwab has these in green as a positive effect. It's a positive effect that these dog green boxes are a little closer to the rabbit, but they're not that much closer, and you want to be ahead of the rabbit. See what I'm trying to say? Next, we have the stock market. Now, Charles Schwab also has the stock market in green. Now, the stock market in green, most of the analysts are saying that whenever the Federal Reserve before in the history has raised rates, that the stock market has benefited. Well, when we take a look at that, the reason in the past that the Federal Reserve has raised rates is because the economy is steaming ahead. The economy has a lot of momentum behind it. What makes this time frame very interesting is a lot of the economic numbers aren't steaming ahead, but Janet Yellen still is saying that she wants to raise rates. That's why she's very careful of not raising rates. You see, we talked before a little bit about that Janet Yellen is going to have to convince the market and investors that even though she's leaving on vacation from Pennsylvania to Florida, that she's going to stop and take so long to get to her destination of the normal rates of 3 to 4% city in Florida that we don't even have to consider it because she doesn't want anybody selling stocks. But the major difference is we don't have a good economic backdrop right now in the economy. So the mere fact that if we can't, corporate profits have fell in the last year. I mean, housing is sort of stagnant. A lot of economic indicators are not moving a lot higher. So you can only imagine if they're not gaining momentum at zero rates, they're going to even get slower at a higher rate than zero, let alone a destination. So there's probably going to be a negative impact. It's not going to be green, it should be red, right? So there's going to be a negative impact on the stock market. Now, financial stocks is also green. Now, Charles Schwab happens to be a part of that sector. Now, rising rates, there is a differential on money markets and on those types of investments that they have green here, savings, cash, CDs. Now, it's just a coincidence, though, that the majority of Charles Schwab's profits come from the differential of having investors put their money in the green boxes of cash, savings, and CDs. See, that's how Charles Schwab makes a lot of money in that differential of what they pay interest as to what they receive. That's why their profits in that part of it has really struggled. Now, that's just a coincidence, though, that they have them in green, and that's where they want you to put your money, is where Charles Schwab can make the most differential in their profits. That's just a coincidence. Now, they also have here the negative effects of utilities, adjustable rate mortgages, auto loans, and home equity loans. Well, there's no question. Those are short-term rates that are not fixed. So when the Fed raises the bottom rate up 25 basis points, not only are these short-term rates going to go up for borrowers, but the key again is that not only may they go up a little bit, but investors and Wall Street is always looking ahead. So that Yellen needs to be able to really play a poker hand here so that they don't get investors going out ahead, getting to that normal rate of 3 to 4%. If that's the case, then these rates are going to go up a lot more. This is going to utilities, auto loans, home equity loans. It's going to get ugly. Then what is that going to do to the economy? See, that's going to make it slow even more. You see the catch-22 that the Federal Reserve is in. Now, obviously, too, with rising rates, for the last 30 years, we've had falling rates. Now, with falling interest rates, that induces spending and borrowing. Well, borrowing and spending is easy. It's the other side that's hard. We haven't gone this way yet. So that, spending and borrowing is easy. The hard part is under-consuming and paying it back. And that's what the rising rates are going to have. Those are the consequences of rising rates. Well, what's that going to have on the economy? To think that how it's going to affect the economy and the other investments is going to be proportional. That would be like saying that it's just going to be as easy to pay back the money and underconsume as it was to spend and borrow. I don't think that makes very much common sense. We all know that when you spend and borrow before Christmas is a lot easier than paying it back when the bill comes in after Christmas. Also with the refis, when we have a market that's the interest rates are rising, well, the refi market has been like an ATM machine, right? Because every time the interest rates fall, homeowners refinance, and then they try to extract the cash. This is how the Home Depots, the Lowe's, people are spending money in those types of stores or remodeling their kitchens from this effect of interest rates falling. What's going to happen when interest rates go the other way? Are as many people and homeowners going to refi their house at a higher rate? Even if you have equity, are they going to refi at a higher rate? When the rates actually get higher than what your current mortgage is? I mean, are you going to extract cash and raise your mortgage payment? I mean, I guess you could still get the cash, maybe if the banks would do it, but I mean, your payment's going to be higher, not lower. Also, something to think about is when rates start rising, I mean, would you rather own a home, pay more for the home at a 4% interest rate, or would you rather have an interest rate of 10% and pay a lot less for the home? There could be some debate here. I mean, one would say that I would rather go into debt less, right? Let's say it's a $250,000 home at 4%. Well, let's say an interest rate of 10%. Well, if wages stay flat and interest rates go up, Americans can only afford so much of their mortgage. So that means home prices have to come down. Well, if that $250,000 home comes down to, let's just, for example, say $150,000, well, would you rather have a mortgage of 4% at $250,000 or 10% at $150,000? I think some people would rather go less into debt, owe $150,000, and let's assume that for the case, it's the same payment, right? Now, these numbers may not match, but you understand what I'm trying to say. It's the same payment. I'd rather owe less and have a 10% interest rate. Why? Well, because a 10% interest rate has a chance to come down and I can refi. See, there is this is a pretty good debate, right? Whereas the 4% interest rate, the opportunity now, yes, it seems like for the last 30 years, rates have fallen. Well, now if we go in reverse, you're not going to have that chance to refi lower than you did before. So it is going to affect home prices as well. Now, and again, what's that going to do to the economy? What's it going to do if the stock market falls? Those are the two pillars that make people feel wealthier to go out and spend. Once again, here's why Janet Yellen doesn't want to take the rug out from the stock market and the housing market and the refi market. She doesn't want to make pension funds, if the stock market goes down, pension funds are going to have a much harder time making payments to the recipients of the pension, right? Let alone to give the pensioners a raise. We talked about that in another video. Now, lastly, they have in yellow the uncertain impact, not really certain as to what's going to happen with long-term bonds, mortgage rates, asset-backed loans, and short-term bonds. Well, we're already talking now about the high-yield market today that's basically unfolding and falling. Now, why are high-yield bonds falling in price? Yields are rising. Well, a lot of the high-yield bond market was issued by energy companies. Now, we know the energy companies now are struggling. Now, a few years ago, they weren't struggling. That's because oil prices were higher and they were drilling. But they were borrowing the money to drill. Why? Because the Federal Reserve had interest rates so low, they could borrow money. Plus, they had QE, the printing of money. The money was easy. The energy companies, they saw all of these profits at a certain oil price, so they borrowed the money to drill. Now, all of a sudden, the price of oil comes down. Well, QE has stopped. So the long-term, or the high-yield bonds now have a little bit of a problem because of paying back the interest, let alone interest rates rising. It's actually the Federal Reserve that caused this by lowering interest rates to zero, because what happens is investors were looking for a better yield. Well, what a better way, if investors want the demand, who's going to supply that demand? The energy companies. They supplied it to be able to drill. The investors bought it, or the advisors bought it, because they wanted to stretch that yield. They wanted to get a better return for their investors, and they didn't really see the risk, even though the yield was higher. Higher yield, higher risk. Higher return, higher risk. That definition of gravity never changes. Now, we already talked about mortgage rates and how that could be affected. Obviously, commercial loans that are short-term focused as well, that those resets, right? Those commercial loan resets. I mean, if she goes to her destination, which she's going to try to convince the market that she isn't going to do. Now, the Federal Reserve can only affect short-term rates. Now, it is true that longer-term rates are sort of tied to shorter-term rates, but the Federal Reserve doesn't have as much influence on that as they do on the shorter-term rates. If our creditors feel that we're creating